right, let's get this slideshow started. All right, so today, I guess I better introduce myself first. I'm Don Miller. Many of the attendees know me, but for those of you who don't, I'm the Data Innovation Manager here at IDS. For the last 39 years, I've worked with or for dealerships. And for the better part of the last 20 years, I've been providing consulting and data analytics, pushing dealers towards a data-driven approach to their business. In 2018, I helped develop IDS's Repair of its Cycle Time report used by dealers in North America to monitor and manage cycle times. And a couple of years ago, I developed Leadership Insights. It's a data analytics platform for IDS dealers encompassing their whole operation. Today, we're going to be looking at some sales and service trends, and we're going to wrap up with some projections for the next couple of years. All right, first thing we're going to look at is the agenda. The first thing we're going to talk about is the data source, where we're getting the data from, and the attributes of this data set that we're going to be using today. Then we're going to go through some sales and F&I trends, as well as some service trends, and the summary and key takeaways. But like I said, we're also going to look at a little bit of forecast for the next couple of years. We'll talk in more detail about that when we get to the end. All right, first up, the data source. We've got a large database, transactional database, probably the largest transactional database for RV dealers in the US, in North America probably. But for today's presentation, whenever I do year-over-year comparisons, I like to have it pared down to a specific set of dealers that had consistent transactions over the last several years. And we're going to go back to 2018 on our data set. So we're going to look for dealers that have consistently sold stuff through those all 7 years. We're going to part down to just US RV dealers. And when we do that, we get 195 same store rooftops for dealerships for this data set. Now, 195 may not sound like a big number, but it's actually huge. Over the 7 years, we've got 1.1 million deals, total completed delivered deals, for almost $52 billion in total revenue. So very robust data set for sales. On the service side, we've got 4.2 million total work orders, or for like 4 billion, a little over $4 billion in total service sales. So again, a very robust data set with lots of information to look at. The demographics of the dealerships that are in this group, we've got a good spread across volume. For on the sales side, we've got about 38% of the data of this 195 dealerships that did under $30 million. We've got 34% that did over $90 million, and another 28% that ran in between. So we've got a good spread across volume and a good spread geographically as well across the U.S. All right, so let's dive right in. And let's start off with some sales and F&I trends. Now, this first slide, it's not going to be a big shock to anybody who's been in the business. This is just looking at the volume of deals, not revenue, but volume of deals over the last 7 years, going back to 2019. New vehicles, used vehicles, and we do break out consignment because their numbers are different enough from used that I want you to be aware of as well. So year-over-year numbers that we're looking at, we obviously saw the big increase in 2020 and 2021. 22 was a significant drop from 21. And 23 was continuing that significant drop. But 24, it kind of leveled out a little bit. And then 25, it basically broke even from 2024. So we're seeing a slowing decline in 25. At 25's average per dealership, it's 22% less deals than we did in 2019. So it's about 86 deals per dealership less than where we were in 2019. The 2025 average ended up total with all new and used and consignment per dealership about 303 total sales per year per dealership. If we break that down and look at revenue for all of them, it's a little different story. Still see the spike in 21 and 22, 20 and 21 and 22 for new, for used, and consignment. The year-over-year numbers, again, should be a big surprise. Huge jumps in 20 and 21. A pretty significant decline in the next couple of years over 22, 23, and 24, but a little bit of an uptick in 25. And where the bigger difference comes in, it's the first increase in 4 years, but we're 5% higher in revenue despite 22% less sales. So what that tells us, the selling price has obviously increased a ton. Again, probably not a huge surprise for everybody here, but I want to point out that the hard true numbers there. We did finally see a little bit of an increase last year, so we're starting to see a slowdown in revenue, but it's starting to pick back up a little bit, so it's good to see. The 2025 average for all units, total revenue was about $14.5 million per dealership. If we break that down to the individual types of units, so we're going to look at new units first. This is by revenue, and it's about what we expect. It kind of matches where we were. We're still a little bit down in 2025 compared to 2024, but not a lot. And we're seeing a reduced decline over the last 12 months or so. So it has started to slow down. We're kind of hitting that plateau, I think, on new sales. It's still a little bit higher than the 2019 average, not by much, with about a $10 million average per dealership in 2025 for new revenue. The used revenue is a little different story, though. We had the spike in 21 and 22. We had a pretty significant decline in 23, slower decline in 24, but a 7% gain last year in revenue from used sales. So it's, again, our first increase in 4 years, and you're going to see that as a kind of a trend across the sales numbers here. 9% higher than where we were at in 2019's average, and the total for this year was 4.2 million compared to 2019's 3.8. So we're finally seeing, like I said, I think we've hit the low in 24 for revenue. We're starting to see some actually a pretty decent increase year over year in 2025 for used revenue. Now, consignment, again, the reason I put this in here, we break it out separately, and I wanted to make sure everybody's aware of this. When I look at these averages, not every dealer in this 195 dealership data set sells consignment units, but the averages we're seeing are broken out across all 195. So the ones that are actually doing it's about 50% of the dealers are actually doing consignment. So just basically double those numbers. But I wanted to show you the trend that we're seeing is a pretty significant increase. Just in the last year, we saw a 31% increase over 2024. 2 years of growth. 24 was 9% above 2023. But the big story, 150% higher revenue per dealership compared to 2019. So a significant increase in consignment units, up to $375 average across all 195, but probably closer to $750,000 to $800,000 per dealership that's actually doing consignment units. So if you're not doing those, you might want to look into it. It's a significant growth market. If we look at the individual margins for units, if we start off with looking at the new unit margin in 2019, it was about 10.5%. 2020, 21 jumped huge, almost to 20%. 2021 started to taper off in 22, and then everybody realized we had way too much inventory in the lot, so it dropped dramatically in 23, down to 9.5%. So another decline in 2024, but 2025 we saw a little bit of an increase. Actually, the first increase in 4 years. I know I'm repeating myself, but that's the trend we're seeing across these trends. 1.1 below the 2019 average. So even though we saw an increase, it's still a little bit lower than the pre-2020 average, but not much. But it's the highest percentage we've seen since 2022. So the highest one we've seen in the last 3 years. So we're starting to see some improvements in margin where revenue's kind of evening out, but number of units is still declining. So glad to see we're coming around in the plateau on that. The average margin on used units obviously has always been significantly higher than new. And again, not a big surprise, big increase in 20 and 21, still pretty high in 22, but dropped off in 23 and 24, and back up just a touch in 2025. So again, I think we hit the plateau or the valley in 24, and we're starting to climb out a little bit in 25. First increase in 4 years. About 0.5% lower than it was in 2019, but also about 0.75% higher than it was in 2024. So again, nice to see that we're starting to creep it up a little bit, which is great to see, especially in the used market. On consignment, again, we break it out because the trends are a little different. Consignment's been pretty consistent around the 14 to 15%. Not a huge difference. We saw some declines there, moving from 21 to 24. Finally see a little bit of an increase in 2025. So repeating the common theme here, increased for the first time in 4 years, about 0.5% higher than 2019's average, and it's the highest percentage again since 2022. So again, I think we hit the valley in 24, and we're starting to climb out in 25 on margins. So what's that mean on all units? 12.5%, 14.5%, all the way up to 19.6% in 21. Starting to come down, significant drop in 23. Not so much of a drop in 24, and a little bit of an increase in 25. So again, not a huge surprise. I don't think this will be too shocking, but what I want to really reemphasize and point out is we're starting to see the increases. We're starting to see the increase in revenue, starting to see the increase in margin, 1%, almost a little over 1% more than it was in 2024. The bigger story, I think, again, everything was kind of leveling out and starting to improve. The bigger story, I think, is F&I. When we look at what kind of profit we're generating from the F&I department, it stayed pretty healthy throughout those 7 years. We saw quite a bit of an increase, obviously, in 21 and 20 with the increase in sales. The general profit rose 25% in 2021 compared to 2020, and that was an increase of 21% over 2019. And 2019 was a 6% increase over 2018. Then the bottom kind of fell out 22 and 23, starting to rebound a little bit, but a really nice improvement last year, up 8% compared to 2024. But the bigger story, I think, here is it's 23% higher than it was in 2019. And again, we were 22% lower in sales, number of sales total, but 23% higher in total F&I profit generated compared to the 2019 average. And the highest dollar amount we've seen over the last several years as well, a little over $1 million per dealership. So some nice averages there, and again, some nice improvements. And if we break that out, I think what's driving a lot of that growth in F&I, not just the increase in pricing, which I know drives revenue, reserves, and product pricing, but the finance penetration increase is allowing more opportunities for the F&I managers, the F&I department, to make that extra revenue. We've gone from about a 59% average to a 64% average with a 3% gain just in the last year. New is considerably higher than used as far as finance penetration. When you look at this, the overall for all sales up to 64%, new sales is up to 70%. So 70% of all the new units delivered in 2025 were financed at the dealership, giving you that great opportunity for the additional profit. Used increased to 56%. You say, well, that's quite a bit lower. It's close to half, but it was at 45% just in 2019. So that's up 10% over the last 7 years. So I think we're going to see some nice growth continuing as the prices increase. I think that's what's driving a lot of this as well, is the finance penetration is increasing. The other thing that's increasing is the percent of price. F&I profit as a percent of the selling price of the units delivered. Yeah, the price has increased, but so has the production. Across the board, we've gone from about a 6% of total selling price all the way up to 7.1% for all units, new and used. And if we look at just the new units, it's very close. Used is about the same. It had a pretty significant dip in 23, but came right back to right around that 7% mark. 7.1 was an all-new record, obviously, over the last several years. New sales is slightly higher at 7.3, and used is slightly lower at 6.8. So right around that 7% of the selling price is what the F&I is producing on an average, which again is a nice improvement. And tie that in with the additional increase in price is a significant increase in F&I profit. Now, what's that mean for the total variable gross profit of the dealerships? Of these 195 dealerships, gross profit produced from the sale of new vehicles, as you can see, trends right with the sales numbers, same with the used, consignment, and F&I. Again, not a huge surprise. We had a huge increase in 2020, bigger increase in 21. 22 saw a decline, but was still a very impressive number compared to the previous years. 23 saw the bottom drop out, basically. 24 was still a pretty significant decline from the previous year, but in 2025, we had a 9% increase of total variable gross profit, front end and back end gross profit. So it's nice to see that improvement. Again, following the trend, first increase in 4 years, 6% more gross profit produced than 2019's average, despite 22% less in sales, number of sales. So it's some nice production, nice increase there for 2025, and significant increase over 2024. averaging about 2.6 million in gross profit per dealership. 38% of that profit is coming from the F&I department. So I expect that actually to grow a little bit more over the next few years as well. So it's an interesting mix. After several years of major declines, 2025 finished up on a very positive note for the sales side of it. So now let's take a look at the service trends over the last several years. All right. First thing we're going to look at is the volume of work orders coming through the service departments. Looking at annual volume over the last several years. And this is internal, external, and warranty all included. Volume has been down over the last 3 years, down 10%, 7%, 6% this last year. So work order volume continues to decline, down 6% from the 2019 average, which unfortunately means that it's the lowest volume we've seen in the last 7 years. At 2,209 total work orders on average completed in 2025 compared to 2,356 that were done back in 2019. And like I said, unfortunately, that's the lowest volume we've seen in the last 7 years. But what's that mean for revenue? So let's take a look at work order revenue by source. So we've got labor revenue, parts revenue, extras, and sublet, all combined to give you these numbers. And it's not quite a severe decline, but it is still declining, down 2%, 5%, 5%. So we're still seeing some slight declines over the last few years, but it is quite a bit higher than the 2019 figure. And that's obviously due to increased pricing of parts, labor, everything is increasing. So despite 6% fewer work orders, they're 29% higher in revenue for the service department compared to 2019. So some positives there. Yeah, we're seeing declines, but it is significantly higher than it was in 2020 and 2019. And I think it's higher as it was in 2021 as well. 2025 average, about $2.4 million per dealership in work order revenue. If we break that down by bill type, I think it tells a little bit more of the story. If we look at it by warranty, external pay or customer pay, and internals, I think it tells a little bit different story. The work order revenue by warranty, and this is labor, parts, extras, everything included in that. Then you add in work order external pay or customer pay and internal work orders. It's going to be the same trend line because it's the same revenue. We're just breaking out a little differently so you can see the total percentages. Warranty in 2025 represented 15% of the total revenue generated on work orders. External pay or customer pay generated 38% of the total revenue. And internals made up the difference. 46, 47% of the total revenue is coming from internal work orders. If we look at those individually, it tells an interesting story. This is the one I like here because when you look at the trend on warranty, it's a little different from the trend on sales. The spike in sales was in 20 and 21. 22 volume was still pretty decent. But the increase in warranty revenue didn't really pick up until 22 and 23. So it seems to be about a 2-year delay before the increase. If you have a huge increase in sales, about 2 years later, you're still seeing an increase in warranty. But that also means with the decline in sales, we're starting to see the decline in warranty with about a 2-year delay. We saw a huge decrease in 23 in sales, and here in 25, we saw a 14% decrease in year-over-year warranty revenue. And again, that's labor, parts, and extras. So it's following that trend, and if it continues to follow that trend, because sales are just now starting to pick back up, I expect this trend to continue for the next couple of years as well. Trending down over the last couple of years, 13% higher than 2019's average, but again, I think it's going to trend down a little bit lower, and that was the lowest amount we saw since 2020, beating 2021 by about $3,000 or something like that. So interesting. Just I really thought that the delay in revenue was very interesting as well. If we look at external, it tells a little different story. We're seeing some pretty nice increases. Yeah, 2025 down. 2025 was down about 6% from 2019. It's the first decline we've seen over the last 7 years for external pay revenue, but it's also 48% higher than 2019's average. So really nice increase. It has dropped a little bit, but I don't expect it to drop much more than that. It is the lowest amount we've seen since 2023, but it's still a very significant increase over the 2020 and 2019 averages. So it's quite a jump when you look at that. And we look at internals, it's going to follow very similar to what the trend is in sales. Obviously, if we're not needing to process more units to get them on the lot, these numbers will drop a little bit. So over the last several years, 23, 24, and 25, we've seen reductions, but those reductions are slow. We're starting to see it level out again. I think we've gone through the valley and we're starting to come out the other side on the internal revenue. Still about 22% above 2019's average, but it's also the lowest amount we've seen since 2020. And that, again, matches with the sales numbers we're seeing. There's just not as much being processed in the shop. Hours per work order really hasn't changed much when you look at the average across the span there. The average through 2019 through 2022 is right at 4 hours per work order. We've seen a little bit increase over the last couple of years, but nothing significant. Slight increases in external and warranty hours with a slight decline in internal hours, but again, nothing real significant. The average sales per work order has improved greatly over the last 7 years, from a low of $792 all the way up to $1,079. That's 36% increase since then. But it does seem that the increases are leveling out. So I don't know if it won't climb near as much as it did in 21 and 22, but I do expect it to still increase a little bit over the next several years. And I think really what's driving that is the effective labor rate. We're seeing some steady increases with the effective labor rate. And I apologize ahead of time, this graphic gets a little crowded, but I wanted you to see each of the different pay types broken out. So for warranty, we've reached a high of $178 per hour for effective labor rate in 2025, up from $132 back in 2019. Customer pay has gone from about $124 all the way up to $170 in 2025. And internals have gone from about $100 average in 2019 to $135 in 2025. And if we average that out across all of the work orders, we're looking at about $153 average, which is a fairly significant increase from where we were at $113 back in 2019. And I think that's what's driving that, and the increased parts prices is really what's driving that sales per work order to be as high as it is. About a 35% increase over 7 years, so it makes sense. We're slowing to about a $5 increase per year, not quite like we had back in 21 and 22 where it was $10, $15 increases, but we're still seeing some increases. And the other thing that really drives overall profitability or overall revenue in a service department is repair event cycle time. And we've seen some nice improvements in cycle time over the last several years, but we're not quite back to the pre-pandemic levels. For all work orders, it's down to about a 31-day average. For the warranty bottleneck work orders with some kind of warranty included, it's down to about a 44-day average. And for out-of-stock parts, went from a high of 88 days in 2022 down to about a 56-day average. A nice, pretty steep decline there over the last several years. Do want to point out that the repair event cycle time data set is a little different from the year-over-year same store data set. This excludes any internals. This is strictly customer-facing repair event cycle times. Internals, you have too much variance in, and this is really what the customer-facing side of it's really what makes the difference anyway with the customers. The faster you can get it through for the customer, the better, the happier they are, and the quicker you can empty that bay and use it for the next customer. So we're seeing some nice improvements. Overall repair event cycle time is down to the lowest it's been since 2020. Out of stock repair event cycle time is the lowest it's been since 2019. We're sneaking back into that pre-pandemic time. And warranty repair event cycle time is down to the lowest it's been since 2021. So it's, again, some nice improvements, not quite where we want to be yet, obviously, but still some very nice improvements over the last 3 or 4 years in repair event cycle times. For summary and key takeaways, I just want to kind of review some of the highlights we talked about here recently. On the sales side, sales revenue increased for the first time in 4 years. Used and consignment units show the strongest growth, and margins have improved across all units. So we're seeing some nice, like I said, I think 2024 is our valley, and we're starting to climb out a little bit. F&I profit is continuing to increase up to a little over $1 million average per dealership, a 23% increase from 2019 despite fewer sales, despite 22% fewer sales, so a significant increase in F&I. Work order volume has declined, but sales per work order has increased. Labor rates and sales per work order hit all new highs. So we've seen some very, very positive things to take away from the year-over-year comparisons I just showed you. Now, I'm going to give you this big stamp of warning right front here. This is these forecasts I'm going to show you are AI generated. We have a corporate version of Microsoft's Copilot AI, their AI. It is a self-contained large language model that is not used to train their general models, so it's walled off from the internet. It learns about our industry. It looks at our trends reports and our documents, and I dumped in these trends that I did for you guys today, and I think, well, give me some projections for the next couple of years. And I tell you what, they make a lot of sense. Now let's take a look and see what it says. For sales, it expects the deal volumes to stabilize in 2026 and to see 2 to 4% growth returning by 27 and 28. So it might be still, as far as the unit sales, still be in the valley a little bit before we start climbing out for 2026. Used units will continue growing at 3 to 6% annually, leading the overall volume gains, which makes sense. Total revenue grows 1 to 4% annually, supported by the mix and pricing. I still think the pricing is going to increase year over year, so we'll probably see that. If sales flatline, we'll still see a little bit of an increase in revenue. Margins will continue to improve to about 1/4 to 1/2% per year across all unit categories. And F&I penetration is expected to rise 67 to 68% by 2028. So we're it's still expecting to see a considerable increase. F&I profit will grow by 3 to 6% year over year, driven by that increased penetration and increased pricing. And variable front and back end total gross profit is expected to grow 3 to 5% annually, with rising F&I contribution contributing the biggest share, I think. For the service side of it, the forecast that came back from Copilot was, despite volume trending slightly downward, rising labor rates and higher sales per work order are expected to drive a 1 to 3% annual revenue growth, which I think is great. Effective labor rate momentum remains strong, and expecting another $3 to $6 increases each year for effective labor rates. And the growing average age of this one kind of stood out to me. It's the growing average age of customer units and increased feature complexity will likely push hours per work order up 2 to 4% annually. Nowhere in my presentation did I talk about aging customer units or increased feature complexity. It learned that from our other trend reports that we've done and incorporated it into this forecast, which I thought was very interesting. So the older the unit gets, the more complex they get, the more it may creep up that hours per work order. Warranty work already declining, forecasted to decrease another 1 to 3% annually over the next couple of years, shifting the revenue mix towards external pay and parts. The customer pay or external pay revenue is projected to grow 2 to 5% annually, supported by rising effective labor rates and increased hours. So again, AI generated, but made a lot of sense. It really fit the trend that I saw as well. The data tells a very clear story. Momentum is returning across our dealership ecosystem, and I think the next couple of years are going to be some pretty strong years. And as my catchphrase, your data is like gold, mine it often. And what I mean by that is, track your KPIs, monitor yourself against yourself, but also monitor yourself against the national and regional averages where you can. If you go to ids-astra.com, you can look up several of our trend reports that are available, along with the dealership industry insights that's put out every month around the 5th of the month or 10th of the month. And we also have repair bit cycle time dashboards that you can do, that you can download at any time, and that breaks it out by regions as well. All right, at this time, I am going to open it up to questions. See if anybody has any questions for me. I'm looking in the chat. I may be in the wrong spot. I just want to make sure I'm the right one. No questions yet. Okay.
We still have time, so please feel free to put them into the box. Will these slides be available? Yes, they will be. We'll send out a recording. Oh, the slide deck itself. Yeah, we can make that available. Yeah.
Sure. Yeah, I can convert to PDF. I don't see their questions, just so you know. So you just read them off to me if you see when they come in.
No problem. So we've got Wade is asking, what's the difference between posted labor rate and effective labor rate?
Effective labor rate takes into account any discounting or like warranty claim that wasn't approved or denied or something like that. It'll take those things into account. It won't always equal the posted. Usually a little bit below the posted, typically.
Okay. Any other questions? We still have some time, so don't be shy. Right. Okay, lots to chew on. Oh, we got another.
Go ahead.
Oh, yeah, one more that came in. Why is the effective labor rate important to track?
It's real important to track, especially if you're looking at it on a service writer, individual service writer level, so you can really see who's giving away the farm and who's not, basically. It's something you definitely want to keep an eye on. And you definitely want to look at it to make sure you're competitive in the market. If you're getting too low, you're suffering profitability-wise. If you're getting too high, you might be scaring some folks off. So definitely something to watch.
Great. And we've got another one. Where can I find more info about IDS?
IDS-astra.com. Website's full of great information.
Yeah, I can attest to that. We're also on LinkedIn and Facebook as well, and YouTube.
There you go. Perfect.
Cool. Anything else?
If you're looking for more information similar to what you saw today, we've got a RV Trends webinar coming up on February 4th at 2 p.m. And that'll cover not just the analytics side of it, but also we did a survey with our dealers as well. So we've got some, what are dealers concentrating on and things like that in that presentation. So check back with us and check the website and get registered for it when you can.
Yeah, that'll be a great opportunity to see how you can take a lot of these trends and findings and then put them into action, how you can actually apply these at your dealership. Oh, we've got another question that came in.
Go ahead.
Rect only covers out of stock and warranty cycles. They're wondering if that's the case.
Yeah, the two main bottlenecks are the out of stock parts and warranty. The overall average repair event cycle time that you saw, the 31-day average, is all work orders. It could be a work order that is customer pay and the parts in stock, which makes up about 40% of all work orders. So it encompasses every single work order at 31%. Those ones for the bottlenecks for out of stock parts is obviously if a work order has an out of stock part or has warranty coverage. And those seem to be the biggest bottlenecks industry-wide.
Right. We've got someone else asking, does the AI generation take into account market conditions, or is it purely based on the data provided?
I would say a little bit of both, probably weighted more towards the data provided, because there's, it's not pulling in manufacturers' projections or anything like that. So it's more about the data provided, looking more specifically at the trends that it sees.
And we've got another one. Do you feel that the effective labor rate will ever reach close to posted labor rate, either customer pay or warranty, as the RV industry recovers?
That's a good question. I'm not sure. I would think it'd get closer, but I don't think it'll ever match it, because you're always going to have warranties that are denied. You're always have some discounting of service built versus collected, things like that. So there'll always be some margin there.
All right, we've got another one. Which reports would I run to see if my techs are logging into jobs and to see if they're being productive to help me identify the quote unquote slackers?
I know it's in leadership insights, you can find it pretty quickly, but check with support to find out specifically which reports to run.
Okay. And we've got another one. I love all these questions. Keep them coming. Can you get a report on the parts that most lead to increased wreck days, and how do I stock the right part at the right time?
Well, the first part of that question is an easy one. In our industry insights, dealership industry insights infographic that we post to our website each month, the very bottom of it includes a list of the top 5 parts that were ordered during the previous quarter, and it shows their cycle times and lead times and things like that. So keep an eye on that bottom piece. If it's parts that you generally order, those are probably the ones you want to order ahead of time.
Okay. So we've got another one that came in. Have you looked at the AI projection across regions, and is there any difference?
I have not looked at it across regions, but I can tell you there would be some significant differences. The data we have is obviously we can break it down to regions, and due to time constraints, I didn't do that today. But yes, there are significant differences in regions. Just as an example, finance penetration in the Midwest is probably 20 percentage points below the national average, whereas the West and the South are quite a bit higher. So there are some significant regional differences. Yep. Weather plays a big impact in that as well with the Northeast too. So.
Great. We've got another one. Have you seen a trend of consignment-only dealerships opening given the profits of them?
Huh. No, I haven't personally. That might be one for more of our sales side to talk with, because I don't know if anybody does just consignment only, but I do know some of the dealers have used only lots. So they probably have consignments on those specifically. But yeah, that would be something that wouldn't surprise me to start seeing that kind of trend. Yep. Great questions.
Yeah, lots of great questions. Got an opportunity if anyone has any last questions to put in.
I'm available too. If you think of something afterwards, just shoot me an email. I'm always available.
Great. Okay, awesome. Oh, we've got one last question stuck in. Can you flag a work order that is nearly 30 days open?
Can you flag it? You can probably categorize it and then track a category, but I don't know if you can actually flag it. Again, in leadership insights, they're already flagged by date. So, but in the IDS itself, I think you can change the category to something like that, so you can view just those. Awesome.
Awesome. Cool. All right. Well, thank you everyone for joining us today. So as I mentioned, you will receive an email with the webinar recording within the next 24 hours. So you can keep an eye out for that. Watch this again, share it with your team. And just a reminder that once you leave the webinar, a short survey will appear on the screen, and we would really appreciate if you took just a couple seconds to give us your feedback. All right, thanks so much for being here, and have a great rest of your day.
Thanks, guys.